every time we run our survey, we have some thematic questions. This time, we asked about macroeconomical trends and how they could be impacting agribusinesses. So the first question we asked was about interest rate and how they could be impacting companies' decision making. We gave them the option of between six potential ways they could be impacting, and they could mark any of those questions or those variables. And the one that stood out to us is the increased project financing costs. So they're saying that the biggest impacts of interest rate today, it's on increasing project financing costs. The second largest was adjusting the timing of investment. So people would be, finagling a little bit when would be the best time to make those investments and how to pay them. And then a third one was actually they don't see impact. So it doesn't seem like the impacts are stark, especially given that third option. But almost 40% are saying that it did increase costs in the recent time. So do you see the same way, Alan? Do you see that the interest rate, even though it seems to be in a place where it could be brought down, it hasn't been in a little while? Do you see that as a major driving force, macroeconomically speaking, in our industry?
Well, frankly, Lorval, I'm a little surprised only 39% said it increased project financing costs, because if interest rates went up, by definition, project financing costs went up. So I would have thought there'd be more than that. That would say 39%. Where I'm more intrigued from the results is there's 60% said that it's either adjusted their investment timing, or it completely postponed or changed the scale of their projects. So while only 39% said it increased financing costs, 60% say interest rates impacted the way in which they're making decisions. So that seems more consistent to me with, yep, in fact, financing costs are higher. Right? It really is impacting for a lot of these folks what they're doing with respect to their investment activity. And we saw within our questions, our base questions, the fifth question is, what do you think about making investments over the next 3 to 5 years? And we saw some improvement in that, but still pessimistic, right? Even the improvements in our decision to make investments is still, I think the index, if I recall correctly, is like 88 on that question, right?
93.
93. So still below 100, right? So still pessimistic. It's improving a little bit. So there are a couple things I find interesting about this as you think about what they're telling us about interest rates. One, they're saying, well, interest rates increase financing costs, but not nearly as many of them said that as I thought. But they did say it's changing their behaviors. What I'm curious about is, it seems to me like they've sort of adjusted to the idea of higher for longer. Interest rates are up, and they're going to be up for longer. And now it's just the cost of doing business. It's going to be, interest rates are going to be higher. That free capital market we used to have, where money was practically free, is behind us now. And most of the industry is recognizing that we're probably not going back there anytime soon. So, yeah, my financing costs are higher, but I'm adjusting some timing and doing some things differently here. But over time, we're adjusting to higher interest rates. That's my take on it.
Really nice. Well, the other question that we ask, it's about inflation, and they're somewhat connected. We asked, how do you think inflation has impacted your operational costs over the past 12 months? And our results show a really clean distribution. We asked them to rank between 1 and 5, where 1 is no increase. We didn't see any inflation impact whatsoever, where 5 is a severe increase. Those extremes had very little response, almost none. And the overall industry stayed on a 3, which means moderate increase, right? I think it's interesting to call out that support services and products, the segment we were just talking about, had the lowest number, or meaning the closest to a smaller impact, which is a 2.6. It's still pretty close to 3. And agricultural production saw the highest impact, was a 3.2. So none of those went into the significance increase level, which is a 4, or a slight increase, which is a 2. So we stayed very close to that moderate level, but it's a very clean distribution across all those 5.
I think one of the things I found interesting about this one, as I thought about it here, everybody recognized that inflation is having an impact on them. They mostly did recognize that it's having some impact, but not a lot. But when you think about this industry, prices are highly volatile across the whole industry. They're changing all the time. Where you see folks are going to feel the most impact on inflation is when prices are typically pretty stable, and then suddenly they start rising because of inflation. Here it's happening in our industry, but it's within the noise, right? The noise of prices are going up and down all the time because of commodity supply and demand situations. That it's hard to see the part that's just the inflation. And I think that's what we're reflecting in our industry, is that, yep, inflation's there. We know it's there. We read about it all the time. We can feel it here, but really it's in the noise of all the ups and downs of our industry's commodity pricing mechanism. So it doesn't have an outlandish impact on us like, say, it would consumers at the grocery store, for example.
Mm-hmm. It's a really interesting comparison, because consumers will buy the same product daily or weekly, and they can see that change in price, very clearly. Farmers will some of the things they will buy just once a year, right? So it's hard for them to piece out what is inflation, what are interest rate impacts, and other things. So,
well, one of the things you got to remember, Lorval, bread in the grocery store, inflation causes bread prices to go up. They rarely go down. But in fertilizer, inflation might be causing fertilizer prices to go up a little bit, but fertilizer prices come back down because you end up with an oversupply, right? So it's harder in our industry to see just that price increase. But when bread prices go up, they go up, right? Oatmeal prices go up. Now eggs, that's a little different. Eggs go up, they go way up for the consumer, but they'll come back down, right? So that's where it'll be harder for the consumer to see for sure. Inflation would be something like an egg, which is such a commodity based product, even in the grocery store. I think that's the same thing you see in agriculture, because we'll see prices go up and down quite a bit. Inflation generally causes prices to go up, not come back down.
Mm-hmm. Makes sense. Well, the other question, and we alluded to this a little bit before, is the idea of how political instability, meaning political uncertainty, changes in government policies, regulations, geopolitical instability. So not just national things, but globally speaking, how that political instability would be affecting companies' long-term planning, right? So there are things that are today, but we're thinking about longer term. And we also asked within a range between 1 and 5, where 1 has no impact and a 5 has a severe impact. And again, we had a distribution where most of the respondents were in the moderate effect, right in the middle, as a number 3. Although we had a little bit more on the fringes than we had in the previous question. But the overall across the industry, we're in the 2.9, between a 1 and 5 range. That a couple segments of the value chain that stand out on that one is input distribution, with 2.4 is the lowest number we've found. So they're not seeing a political instability playing as big of a role as other parts of the industry. But the segment that they come right after, which is input manufacturing, they see the largest impact of political instability with 3.2. So overall, there's this one part of the value chain that has a very unique dynamic where you have the highest and the lowest perception, even though they're somewhat close to each other. But the biggest difference in our survey, two segments that are close to each other, and overall, they're in the moderate effect, just like we saw on the inflation.
Yeah, this one at first sticks out to you with the number being the way it is, particularly input distribution, just showing that it just sees that the input distribution segment sees political instability as less impactful on their long-term planning. Doesn't mean they don't think political instability is, generally speaking, a good thing or a bad thing. Necessarily just says, well, on our planning it doesn't impact us. And why? That they're not international facing. The input distribution does not face international. Input manufacturing is they're global companies and they face international settings. You say, well, the farmer, they're not international either. Yes, they are. All their products end up in an export market, so they're impacted by international. Everybody else here, except for input distribution, has this international impact. Input distribution is very local, right? Very much focused on the U.S. Of course, they're going to have impacts on their cost of their inputs. They're going to have impacts on their demand side. But what we asked here was about your long-term planning of your business, and the long-term planning of input distribution is local. So political instability is really sort of a global phenomenon, and the implications of what it means for global, that's what I'm reading here. And the input distribution says we're kind of isolated from that. It doesn't affect us as much.
Mhm. But everyone says that impact at a certain level, right? Which is something that we've seen across all the questions that we asked. There are some impacts. No one is, or not no one, but most people are not in either extreme where it's going to completely change the game for me or it's not going to change at all. They're kind of in the middle for all the questions. Okay, now the second to last question that we asked is about labor. This is a interesting and touchy subject for most people that we talk to. Labor is being an issue, but in our survey, it showed up as actually the lowest impact of all the macroeconomical forces that we asked about, where the largest number of responses were in this light impact, and between a 1 and 5, that's a number 2, where 1 is no impact whatsoever, 5 is a very severe impact. They are in the slight impact most. The overall industry is at 2.4. That's something that stands out, Alan, is that food manufacturing had the highest or presented the highest impact of labor with 2.7, followed by input distribution at 2.6, and then support services and products. And I think that makes a ton of sense, has the lowest impact at 2.1. So here, even though we talk a lot about labor and we hear a lot about labor, it feels to me that given the forces we survey is the one that is impacting the least. It doesn't say, I'm not saying it doesn't impact, but it is the ones we have the least important.
Labor is impactful for a company when economies are growing strong. Because we're a bit slower growth with respect to economic conditions right now, we feel less pressure to hire. And when we feel less pressure to hire, we kind of forget that labor is tight and could be a problem for us hiring. It's only when we really are growing and we're trying to hire, and so is everybody else, where you feel that pressure. That's my take on this right now, is that labor doesn't feel like a problem at the moment because the pressure is not to go hire people. The pressure is to figure out how to survive the economic conditions that we're currently in. And so we're doing less hiring, and that feels like there's less pressure in this area. If you're somebody who is hiring, I can assure you, you feel the pressure of labor. I don't think there's any doubt about that, right? It's going to be a significant impact when you're trying to find them. I'm just got through visiting with an ag input distribution company who's trying to hire in the data analytics and data engineering spaces, right? The digital spaces. They're struggling to find the labor. Now, you wouldn't think you would, because there's a fair amount of disruption in that side of the industry as well, and there's been a fair amount of layoffs. But those layoffs don't happen in the rural communities where input distribution lies. So where input distribution is finding supply of people in those sort of skill set areas, very difficult. You ask them, they tell you that the labor is a problem, right? But it's unique to where your circumstances are in the economy where you currently face. And I think in general right now we have a little less pressure to hire.
And that tracks perfectly with the idea of current conditions being mostly okay, a little bit lower, but not tremendously lower, but future being low. So they're not willing to make that kind of commitment right now because they're going to have to hold those people in jobs. They're not hiring for today, right? And if they're thinking that the future is looking a little bit gloomy, they might hold off on those hiring. So less making the pressure of labor a little bit lower. That makes total sense to me. So now asking about market uncertainty on major investments. So thinking about fluctuations in demand, economic instability, unpredictable industry trends. So we had one question about political instability and geopolitical instability. This is more on the economical financial side. So this is more like, how do you see overall changes in customer demand or consumer demand trickling down the value chain and behaving in a way that is hard for you to understand. For this one, most companies or most respondents were in the they're still evaluating, but they're not making major changes. So market uncertainty is playing a role, but they're looking at it. They're not making any changes. Where our range goes from 1 to 5, where 1 is just continue as is, no changes whatsoever. And 5 is just holding down all investments, not making any investments until we see what's going on. And that tracks very closely to what we've seen, where all of our segments, or most of our segments, they had the investment numbers going okay. They're like, we'll still continue to make investments. We're still gonna, perceive today as a good time to make some large investments. And so it shows that they're either evaluating or slowing down a little bit, but they're continuing in the same direction as they are. And a way to see that is our overall industry value in a range between 1 and 5 is 2.6, where the lowest number was 2.37 on input distribution, which tracks with what we've seen in our indices. They're continue as is basically. And the highest number is 2.9, not a big difference at all in food manufacturing, where we saw a lot more variance in how they perceive current and future situations, especially the future ones, right? So that plays a role in investments for sure. So good dynamic here of overall low impact or lower impact on investments. How do you see this, Alan? What is your perspective?
I think the industry has a plan for what it needs to do with respect to its investments to maintain its competitiveness, and that the market uncertainty we're facing is not enough higher than normal. Right, we're in a downtrend, but this downtrend in our overall ag economy is not surprising. People knew this was coming, right? It's not a shock to the system in terms of overall market uncertainty. And so I just think that it's a good indication that the industry understands that there are highs and lows in our industry, and you have to make investments through it. And that's really, I think, the message we've got here is that we'll continue to make our investments through all this uncertainty because we know we have to maintain competitiveness.
It feels to me, the analogy I've used when explaining this data to someone else feels like we're driving through a little bit of an icy patch. We're still going forward. We just took the foot off the gas a little bit. We're still going down the same direction, holding steady to the wheel, and then continue forward. It feels like hitting the brake right now is the most dangerous thing you can do, because at some point things might pick up again, and when they do, if you were holding back, your competitors are going to surpass you. And as you said, Alan, most of those companies, almost all of them, are playing on an international field, and other places of the world are still continue as they were last year. So it makes sense that our industry, being more used to overall volatility, is still investing the way they were before.
I still have a good farmer friend who's told me many times, I'm not all that excited about getting price stability. I like market uncertainty. Uncertainty in markets provides opportunities. If you don't have any uncertainty at all, right, prices are just stable. There's no opportunities left. So I think it sometimes is the reflection of our industry's understanding that market uncertainties actually create opportunity, and you've got to be in a position to be able to take advantage of that when it presents itself.
Yeah, I agree 100%. Okay, our last question, and it's a hot topic right now, tariffs. So we asked our survey respondents, how do they feel effects, potential effects of tariffs on their companies? So we gave them a few options. So one is increased cost of material supplies or inputs. The second one was uncertainty in price and contract planning. The third one was market competitiveness, so think about domestic versus foreign products, changes in international trade opportunities, and then disruptions in the supply chain reliability. And the two most important variables or options marked were, because they had to rank that between 1 and 5, right? So increased cost for material supplies and inputs was the biggest one. And we've seen that before, thinking about costs and how interest rates and all those things apply. Our industry is thinking about cost control. And then the second one is uncertainty in pricing and contract planning. So really cool dynamic here. They're thinking about inputs and how they come in. So how do I control my costs? And then on the other end, how I control my revenues because of the pricing things I'm putting out. They're not worrying much about how competitive I'm being in an international field, maybe because they can't control it, but they can control when they sign contracts, they can control their costs. So it seems to me, at least, Alan, I want to see your perspective on this. Our industry is looking at tariffs as something very operational, or at least the effects are going to be operational, how they manage their businesses is not as strategic or how high level regarding long-term planning. As you said, farmers are not going to move to another country to produce, right? They're still going to be where they are. So that long-term planning, changing their strategy, might not be something they're thinking about. Top of mind for them, cost and revenue.
Yeah, I think I think that these are the things that are the natural pieces for you to think about. What are the impacts going to be? The impacts are going to be input costs are going to go up, right? And then what happens to my demand side on pricing, contracting. So I think from a ranking perspective, them ranking those things first and second doesn't surprise me too much. I would have thought before we saw the answers here, the disruptions in supply chains would have been higher. But the more I think about it, the more I recognize across our segments, at least 3 of those 5 segments, 4 of those 6 segments, really, the supply chains aren't as long and don't impact them as much. Right, so it's input manufacturing is going to be the one that's got really big supply chain disruption issues that they got to deal with, and probably food manufacturing may have some of that that they would face as well with respect to supply chain disruption. So we hear a lot about that these days across our industry. Folks start to talk about supply chain disruptions, but those supply chain disruptions are at the borders. And so it's only those companies really that face the cross-border issues that are going to see those disruptions in their supply chains. And I think that's reflected here in it being ranked last, where I wouldn't have thought it'd be ranked last. I'd thought it'd been ranked higher. It may be that it's a reflection of the fact that our supply chain, our overall ag or food supply chain, is mostly domestic, right? Except for those ends. Well, maybe around product processing and handling. So our exporters and then our ag input suppliers who are importing goods. Those are the ones that have the biggest impacts with respect to supply chain. So that's the place where I saw the surprise. Not a surprise that it's going to have impacts on costs and pricing, and that's what we're most concerned about.
And that's usually how the companies in our value chain think, especially farmers, right? They come from, there are very few things I can control. The first one is cost. and the second one is when and at what level I close my contracts. And those are things that, having on-farm storage would allow you to play around those things, and that's probably the things that most of them are thinking about right now. Okay, so that sums it up, and thank you everyone for watching. And in June, we're going to be collecting our new survey. I hope you have a chance to respond to it, and then in the couple months after that, you should be seeing some of these videos being published again.
Thanks.